$17.5 billion. One vendor's ecosystem investments. Now follow the receipt. Revenue may be real yet fragile. 5 disclosures reveal who supplied the cash. That matters for index funds, cloud bills, and every company buying AI capacity. Later, we build a 5-disclosure test that separates independent demand from financed acceleration. A receipt can look ordinary while the money takes a very unusual route. Picture $1 of AI revenue. A chip maker sells hardware. A cloud builder rents the machines. A model company buys the service. An outside customer pays for software. That last payment is the cleanest endpoint. If the chain keeps circling through vendors, sponsors, prepayments, or new debt, the receipt needs more questions. This is not an accusation of fake sales. A contract can follow accounting rules and still depend on a narrow funding web. The market risk is renewal. Capacity is durable only when the final user keeps paying without another rescue round. The scariest-looking line item is often the one people misunderstand. CoreWeave reported about $60.7 billion of remaining performance obligations at year-end. It also said committed contracts commonly include upfront payments. Deferred revenue means money was billed before service was delivered. That can lower collection risk. It does not, by itself, identify the payer's source of funds. The accounting can get more layered. CoreWeave disclosed an OpenAI incentive recorded against revenue over the related service period. FASB says share-based consideration paid to a customer generally reduces revenue unless it buys a separate good or service. That is why contract headlines need the full footnote. Here are the 5 places where a cash receipt starts talking. First, inspect concentration. One customer can support real scale, yet it makes the renewal decision unusually powerful. Second, inspect receivables. Revenue that outruns cash collection deserves a closer look. Neither clue convicts anything. Together, they show how much one payer can move the whole machine. Third, separate bookings from delivery. Remaining obligations can signal demand, but they also measure promises still waiting to become service. Ask whether deposits, milestones, or a single contract explain the balance. A backlog is a schedule. It is not a map of where the customer found cash. Fourth, trace the build-out money. CoreWeave reported about $10.3 billion of property and equipment purchases in 2025. It also reported about $9.3 billion from financing activities. Fast infrastructure growth can be sensible. The question is whether future service cash can carry that financing burden. Fifth, read related commitments and customer funding together. Cerebras disclosed roughly $1 billion from an OpenAI working capital loan for infrastructure delivery. It also said repayment may happen through cash or non-cash service credits. That is a disclosure to understand, not a shortcut to a verdict. Now, the useful twist. None of these 5 clues says demand is imaginary. They tell you where independent demand must prove itself next: broader buyers, steady collections, and service cash that stands without fresh funding. NVIDIA and CoreWeave show why the receipt needs both sides of the transaction. NVIDIA reported $215.9 billion of fiscal 2026 revenue and about $102.7 billion of operating cash flow. That is important counter-evidence against a casual collapse story. Yet it also reported $17.5 billion of private company and infrastructure investments, including model makers that buy its products directly or through cloud providers. NVIDIA also disclosed that 2 direct customers represented 22% and 14% of fiscal 2026 revenue. Concentration does not identify the final users behind those customers. It does mean a few procurement desks can matter enormously. The next filings should show whether the demand base keeps widening. CoreWeave is the sharper stress case because it combines extreme growth with a heavy build-out. It reported about $5.1 billion of revenue and about $3.1 billion of operating cash flow in 2025. One customer supplied 67% of revenue. The receipt is real. Its durability depends on renewal and customer funding strength. The verdict is not a label. It is a checklist for the next receipt. The risk thesis weakens if unaffiliated revenue broadens, receivable days stay steady, operating cash rises without bigger prepayments, and customers fund capacity from recurring product cash. Those are observable checkpoints. They are better evidence than either bubble slogans or victory laps. So return to the receipt. It does not prove a broad fraud. It shows where funded demand could be fragile. Follow the cash from the end user backward. For the research side story, watch The AI That Matched 10 Years of Research in 2 Days.